In late March 2021, several of the world's largest, most sophisticated investment banks discovered within the span of a single weekend that they'd collectively been exposed to roughly $30 billion in losses from a single, relatively obscure investment fund that most of Wall Street had never even heard of. The fund was Archegos Capital Management, run by a man named Bill Hwang. Hwang had previously run a hedge fund called Tiger Asia, which pleaded guilty to criminal fraud charges related to insider trading in 2012, resulting in Hwang being barred from managing outside investor money in several jurisdictions for a period. Rather than disappearing from finance entirely, Hwang restructured his operation as a family office, managing what was technically his own personal wealth rather than outside client money, a structure that allowed him to avoid many of the disclosure requirements and regulatory scrutiny that applied to traditional hedge funds managing other people's capital. Morgan Housel has written that regulatory categories designed decades ago for one purpose sometimes create enormous, unintended blind spots once financial markets evolve in ways the original rules never anticipated. Family offices were traditionally conceived as vehicles for wealthy families to manage their own money privately, without the disclosure obligations designed to protect outside investors who don't have direct access to the fund manager's actual positions and strategy. Hwang's specific insight, whether intentional or simply a byproduct of his particular circumstances following his earlier legal troubles, was that this exemption let him build an enormous, highly leveraged position in global markets with almost none of the transparency that would normally have alerted regulators, banks, or the broader market to the genuine scale of risk accumulating inside his fund. Archegos built massive concentrated positions in a relatively small number of stocks, including Viacom CBS, Discovery, and several Chinese technology companies, using a specific financial instrument called a total return swap. Benjamin Graham's investment philosophy emphasized diversification and margin of safety specifically to protect against exactly the kind of concentrated risk Archegos was building. Hwang's strategy represented almost a direct rejection of that discipline, with the fund's fortune becoming increasingly tied to the performance of a small handful of stocks, using enormous leverage to amplify the size of those positions far beyond what the fund's actual underlying capital would otherwise support. The specific mechanism Hwang used, the total return swap, deserves particular attention because it explains exactly how banks ended up so catastrophically exposed without fully understanding their own collective risk. Rather than directly owning shares in these companies, Archegos entered into swap agreements with multiple different investment banks, where each bank would technically hold the actual shares while Archegos received the economic exposure to that stock's price movement, paying the bank fees and interest in exchange. Because these swap agreements were conducted privately between Archegos and each individual bank, none of the banks Archegos worked with, including Credit Suisse, Nomura, Morgan Stanley, and Goldman Sachs, among others, had complete visibility into how much total exposure Archegos had built across all of its relationships combined. Daniel Kahneman's research into how information fragmented across multiple parties can obscure risk that would be immediately obvious if concentrated within a single, complete view helps explain precisely why this specific structure proved so dangerous. Any individual bank, examining only its own relationship with Archegos, might have seen a position that appeared reasonably sized and adequately collateralized. But Archegos had built substantially similar concentrated positions simultaneously across several different banks, meaning the fund's true aggregate leverage and concentration risk was dramatically higher than what any single lender's own risk models could see, since no single lender had visibility into what Archegos was simultaneously doing with its competitors. Robert Kiyosaki's core lesson about understanding exactly what risk an asset or position actually carries applies here with genuine systemic significance. The banks lending to Archegos believed they held adequately collateralized positions with acceptable risk, based on their own individual relationship with the fund. In reality, because Archegos had fragmented its true total exposure across multiple lenders who couldn't see each other's exposure, the actual systemic risk embedded in the fund's overall position was dramatically larger and more concentrated than any individual bank's internal risk assessment could have possibly detected. In late March 2021, Viacom CBS announced a stock offering that caused its share price to decline sharply, triggering margin calls across Archegos' highly leveraged positions. As the fund failed to meet these margin calls, its lending banks began liquidating the underlying collateral, the actual shares each bank held as part of its swap arrangement with Archegos, in a rapid, largely uncoordinated sequence. Since each bank was independently trying to minimize its own specific losses without full visibility into how the other banks were simultaneously reacting to the same unfolding crisis. This uncoordinated, simultaneous liquidation caused the affected stocks to collapse even further and faster than the initial trigger alone would have caused, since each bank's individual selling added additional downward pressure that made every other bank's position worse in a rapid, self-reinforcing spiral. Credit Suisse alone reported losses of approximately $5.5 billion from its exposure to Archegos, contributing significantly to a broader crisis of confidence in the bank's risk management practices that persisted for years afterward and arguably contributed to the broader institutional troubles that eventually led to Credit Suisse's 2023 collapse and emergency acquisition by UBS. It's worth examining more closely why banks were willing to extend such enormous leverage to a single client with a documented history of securities fraud in the first place. According to subsequent reporting, Archegos generated substantial trading commissions and fees for the banks it worked with, creating a direct financial incentive for individual relationship managers and trading desks to compete for a larger share of Hwang's business, even as some internal risk teams reportedly raised concerns about the scale of exposure being extended. This dynamic, where the people generating revenue from a relationship have different incentives than the people responsible for assessing its risk, recurs constantly throughout financial history, and Archegos represents merely one of its more dramatic modern examples. Some banks, notably Goldman Sachs and Morgan Stanley, reportedly recognized the deteriorating situation slightly earlier than Credit Suisse and Nomura, and moved to liquidate their own collateral positions first, meaning the specific order in which each bank reacted meaningfully determined how much of the total loss each institution ultimately absorbed, turning what was already a chaotic unwind into something resembling a race among sophisticated counterparties to exit first at everyone else's expense. Here's an honest complication worth including, since Archegos' collapse involved a specific combination of factors that makes it considerably more complex than a simple story about one reckless investor. Several of the banks providing leverage to Archegos had genuine internal risk management concerns raised by their own staff prior to the collapse, according to subsequent reporting and regulatory investigation, but those internal warnings were reportedly overridden or inadequately escalated in favor of maintaining a lucrative, ongoing business relationship with a client generating substantial trading fees. This wasn't simply a story about banks being unable to see risk they genuinely couldn't detect. In several documented cases, it was a story about risk that had been identified internally, but that competitive pressure to retain a profitable client relationship caused to be inadequately acted upon. George S. Classen's advice about understanding exactly how much leverage and risk you're actually carrying, rather than relying on any single incomplete view of your total exposure, applies here at an institutional scale that illustrates the underlying principle's importance even for the most sophisticated financial institutions in the world. Archegos' collapse demonstrated that even genuinely experienced, well-resourced banks can fail to adequately assess systemic risk when that risk is deliberately or incidentally fragmented across multiple counterparties who lack visibility into each other's exposure. Following the collapse, Hwang was charged with securities fraud and racketeering, and was ultimately convicted in 2024 on multiple counts related to market manipulation and fraud connected to how he'd built and disguised Archegos' true concentrated exposure across multiple banks. Several of the banks involved faced significant internal reforms and regulatory scrutiny regarding how they'd extended such substantial, poorly monitored leverage to a single client with a documented prior history of securities fraud. This isn't a simple story about one uniquely reckless investor exploiting banks that had no way to protect themselves. What makes Archegos' collapse worth remembering is the specific structural pattern it illustrates. Risk that's fragmented across multiple parties who each see only a partial picture can become dramatically more dangerous than the same risk would be if fully visible to any single observer. And competitive pressure to maintain profitable relationships can cause genuine internal warnings about that risk to go inadequately addressed even at some of the most sophisticated financial institutions in the world. So here's a question worth sitting with. In your own financial life, is your total exposure to any single kind of risk, debt, a specific asset class, a particular counterparty, actually visible to you in one complete picture, or is it fragmented across multiple accounts and relationships in a way that might be obscuring your true total risk? Before you leave, I want to hear from you. Have you ever discovered that your true total exposure to a specific risk was considerably larger than you'd realized, simply because it was spread across multiple accounts or relationships you hadn't fully consolidated in your own thinking? Read a few comments before you go. Some of the most useful realizations on this channel come from people who've recognized exactly this kind of fragmented risk in their own finances before it became a genuine problem. Next week, I'll pick one comment and send its author one of the books that